Hi everyone. So today I want to go through cash flow statements, and in particular, as long as my dog's not too crazy, in particular going through why they're used and what function they have and the different sections of them. One thing I'm not going to go through is the actual formatting itself of that. If you want that, you need to go to your textbook. There's some really good examples of the formatting there that you can have a look at. So with all that said, why don't we just jump straight in? So cash flow statements are really the third key report that we've looked at. So we have looked at the balance sheet, and the balance sheet really shows us the financial position of a business at any one particular point in time. We've also got our income statement, which is showing the profit and loss over a period. Now we're looking at cash flow statements, and the cash flow statement will give us the liquidity and the inflows and outflows of cash for a business over a particular period of time. So the liquidity of a business can't be fully judged by any of the reports we've looked at. It can be hinted at with the balance sheet, and we can look at how a business is roughly performing with our income statement, but it doesn't necessarily show us how well we're going to be able to do things like pay off our debts. So the beauty of a cash flow statement is that it allows us to see how much cash we're generating from our core actual business, our trading day-to-day operations. It shows us whether or not we can meet our obligations at any given point in time, and it shows us how our long-term debt obligations are impacting us. Finally, it can show us the funds that we're using towards new non-current assets. So with that said, the cash flow statement is broken into three main sections. We have operating activities, investing activities, and financing activities. Now, I'm going to go through the investing and financing activities first before we get back to operating activities, because realistically, I think that if it's a cash flow that doesn't fit into either the investing or financing activities, it fits into operating activities, and for that reason, I'm going to go through it last. So, investing activities are all of our purchase and sale of non-current assets. So this could be the purchase of new equipment, it could be the purchase of vehicles, the sale of shop fittings and computers and things like that. But one thing it is not is the profit or loss that we make. Okay? Because when we're considering, say, selling a vehicle and we sell it for $12,000 rather than the anticipated $10,000, yes, we have made a profit of $2,000, but that doesn't change that the inflow of cash is still $12,000. Okay, so keep that in mind. The other thing to note is that this is only non-current assets. This is not anything that we count as inventory. It's only the purchase and sale of non-current assets. We also have financing activities. And financing activities are all cash flows that change the financial structure of the business. So this only includes one of four things, okay? This could be capital injections by the owner. It could be the drawings of cash by the owner. It could be taking out loans, or it could be making payments on loans, okay? Now, it's important to note that whilst we do make payments on loans, interest itself is not a financing activity. Interest doesn't change the financial structure of the business. It's more of a cost that we pay for dealing with the bank, and as a result, it's part of operating activities. So as I said, operating is our day-to-day sort of stuff. This could include anything from making cash sales, collecting cash from our accounts receivable, it could be collecting GST, it could be making payments to our accounts payable, it could be the payment of different expenses, it could be paying GST, it could be making GST settlements. As I said, it could also be interest payments, all of these things. But the one thing to consider is this is our day-to-day core business. And if this is not generating cash, then we need to be concerned. This concern is driven from our evaluation of our cash flow statements. So when we're comparing cash flows, we're comparing from one year to the next, or from one period to the next. We could also be comparing with other businesses in the same industry and things like that. We could be comparing against expected or budgeted cash flows as well. Now, as I said, we need to be making sure that our cash flows from operations are actually generating a net inflow of cash. If not, the only way that we're going to have money to actually pay off things like our long-term debts and stuff like that is through more loans or through the business selling assets off or getting a capital injection by the owner. None of these are sustainable, and in the long term, it won't allow the business to function. So even if you're making a profit, if you're not collecting the cash at the end of the day, you are not going to survive for very long. If a business is running low on cash or has suffered a massive decrease, cash flow statements can help to identify the cause of that and where it's coming from, rather than the balance sheet that will just show that at the start of the period we had a lot of cash, now we have very little cash. The cash flow statement is going to tell us why these things happened. So at first glance, a cash flow statement might not look very glamorous because it just seems like a more detailed version of our statement of receipts and payments, but it gives us so much more information than that. So for that reason, it's really important that we know how to create a cash flow statement, but even more importantly, how to analyze a cash flow statement. So what I'm going to leave you with, guys, is the wrap up of questions that we need to do. And please, whatever you do, make sure that you have an example of how to do a cash flow statement in your exercise book. Okay? So I'll see you guys in class. Have a great night. Bye.
Oh, hi, thanks for checking in. I'm still a piece of garbage.